Hey, Steve Saretsky here. As always, this Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, I'll ask that you hit thumbs up and subscribe. Questions, comments, put those below. I know a bunch of you last week mentioned that your displeasure over my audio situation. Unfortunately, you'll just have to bear through it this week. Hopefully, Santa will bring a new audio and video setup for the new year. But until then, too bad. I want to discuss a little bit on global markets this week. Obviously, what the central bank did earlier this week, hiking interest rates again. Discuss the implications of that moving forward. Some of the Canadian macro stuff, national housing market, and then we'll pretty much end it there. So, I mean, first and foremost, we can talk about Jay Powell, U.S. Federal Reserve, hiking interest rates again. I don't think this was necessarily a surprise. I said that they would do it. They've revised their forecast from 3 hikes to 2 hikes next year, but apparently they're putting their quantitative tightening on basically autopilot, which essentially means that they're going to continue to run off their balance sheet, which has major implications for market liquidity. Basically, them dumping assets is effectively a tightening. And that's something that you really need to be paying attention to. It's just funny because everybody wants to talk about Vancouver and Toronto being these global housing markets. Everyone wants to be here, live here. Great. It's awesome. And I certainly agree that it is a global market. But if you're going to say it's a global market, then why don't we need to start discussing and talking about global events, global things that will impact this housing market, because everybody wants to just talk about what's happening on a micro level. Hey, look what the NDP's doing. Look at my municipal government won't change the zoning. That's not like a global, like what's happening with the U.S. hiking interest rates, the U.S. dollar continuing to strengthen, and with the balance sheet continuing to unwind. That is basically draining global liquidity, and so you can see this in all asset classes right now. Global stock markets are getting obliterated. Emerging currencies have taken a huge hit. This is all coming into basically what's happening with the Federal Reserve. So I think we need to be paying attention to that. Obviously, I don't know what they're going to do moving forward. Nobody knows. If you go and read 10, 20, 30 articles from experts after this recent hike, they all have some different thought process behind how it's going to play out or what's next, how the Fed's going to react. Nobody knows, but it's important to be paying attention to it. Honestly, even the central bank, they don't even know what they're doing. They've come out and basically said this is a financial experiment. We don't know how this plays out. We're all a part of this basically financial experiment. This has never happened before. So you grab your popcorn, you sit in the sidelines, and you enjoy the show, because this is basically, again, this is an experiment. So nobody knows, even the central banks don't know. But something to be paying attention to, because I think that's a huge story playing forward in 2019 is what's going to happen with the global central banks, global liquidity, and more importantly, I think, is the balance sheet. The ECB has also announced that they're no longer going to expand their balance sheet. I mean, I think that's going to have serious implications, particularly for the Eurozone moving forward. Again, that all plays into global markets, Vancouver, Toronto. So, if we take a step back, what's happening here on a more domestic note, RBC released their Q3 report showing that mortgage credit growth for the third quarter, their mortgage credit growth decelerated to its slowest pace of growth in 22 years. Again, 22-year low in mortgage credit growth for Q3. I mean, again, a little bit concerning when you're in an economy that has full employment and your mortgage credit is benign. And so, yes, a lot of that has to do with the stress tests, but we have to understand, how does that impact asset prices? If you understand how banks create money in the form of issuing new loans. When the banks create a new loan, i.e. a mortgage to you, they are basically creating money. So when you have mortgage loan growth decelerate, this is basically a shrinking, a contracting essentially, or a deceleration of the money supply. And you can see that in the M1 money supply growth, which is basically the Bank of Canada references quite often. It's basically your most liquid form of money, essentially. And so you can see that growth has been decelerating quite significantly over the past year and a bit. And that comes when you hike interest rates and you slow loan growth. And so that's going to really start to matter for asset prices, because asset prices, particularly real estate, depends on liquidity. It depends on turnover. More turnover, you generally get higher prices. But it can be the flip on the reverse. Sometimes when you have fewer sales, that starts to build, and then to get the clearance rates, to get the clearance price, you have to get the volume back up. And so that's when you'll start to see the rapid price deceleration. But again, we can see this here. I mean, if you look at the Canada from a mortgage lending perspective, you look at the Canada 5-year government bond, that generally correlates with mortgage rates, 5-year fixed mortgage rates. You've had the 5-year Canada government bond drop 60 basis points in the last several months. After almost peaking out at 2.5%, it's back down to 1.9%. And despite that, the banks have basically not dropped. Some of them have actually increased their 5-year fixed mortgage rates. And so, I'm talking to mortgage brokers and say, well, what's going on? Because generally it should be full on the 5-year bond. What's essentially happening is the cost of funding for banks is going up. The short-term cost of funding for them is going up, and here they are lending out at 5-year rates. So they're essentially to simplify it, dumb it down, is their margins are getting squeezed. So they haven't been able to really lower the rates, and that comes from, again, global markets. When banks have to sell credit products to get some of the funding for these loans, they're going to the open market, and the open market is telling them, no, we want a higher return. And so that's causing the bank to have higher funding costs. So again, we talk about real estate, from such a micro level, it's important to understand that there's really outside factors that are outside of most of our control that are really, truly going to move the housing market. Not so much like what your zoning is doing or how much, the builder can build, whatever, right? So you have different trains of thought, and I tend to focus more on the demand side of things and how that's impacting housing markets versus, developer would prefer to talk about the supply side of things. And again, that's to each their own. But what else are we looking at? So if we talk about for now from a national housing perspective, so we obviously see what's happening in global markets. We can see what's happening domestically, where credit's getting tighter. So we say, okay, we know houses sort of playing out in Vancouver. Now, if we look from a national perspective, because I keep hearing all these, pundits on the TV and whatnot, and issuing these reports, but again, saying that, housing is local. And that may be the case, but certainly our credit markets are not local. It's from a national perspective, and they said the same thing in the U.S. Every housing market is local. Talk to your local realtor. But what we can see, and what we're seeing more so in the modern day, is these housing markets are moving in tandem because it's global credit markets. There's so much financialization of the economy where all this is moving in tandem. And so what we see from the national housing market is you have home sales in November dropped 12% year over year, which was obviously, I would say, exacerbated because last year we had the stress test, people rushing in to get into the market. But if we actually go and say, okay, well, let's see, how's the housing market here performed year to date from January through to the end of November? Let's compare it on a historical time basis. What's happened is year to date, home sales are down 11% from last year. They're below the 10-year average. It's actually the weakest year to date home sales we've had since 2013. And with that, because generally home sales lead prices, i.e. when sales slow down, it takes some time for that to work through into the prices. And we can see in the National Home Price Index that prices have decelerated quite rapidly, where they're now showing a 2% positive year-over-year increase. But again, the housing price index is really just a lagging indicator. It's a smoothed out index. But again, you can see the deceleration. So it's really that trend. It's that movement that you want to focus on. But if we get more micro from that level, you can see like over the last 6 months in particular, where we've seen the more rapid deceleration. The home price index in Greater Vancouver is down 6%, Fraser Valley's down 5%, Calgary's down 3%, Edmonton's down 4%. The only two markets that are showing positive increases in major metros is Ottawa and Montreal, and those are showing a 2% increase over the past 6 months, which again is not much. Those are decelerating as well, but still in positive territory. So I think that's important to keep in mind is what's happening from this again, how these are all correlated. And it's not just Canada. You can see this happening in Sydney, where their prices are down 10%, Melbourne's down 7%, Seattle median home price is down 11% in the past 6 months. This is clearly there's something more going on. So this whole video is basically, hey, listen, let's call Vancouver and Toronto what it is, a global real estate market. It's very much prone to global factors that are going on, and that primarily has to do with the world's reserve currency, largest economy, United States, and what their central bank is doing, and how the liquidity pool is draining. So again, nobody knows how that's going to play out in the next year. I'm not going to here to make any forecasts, but I would certainly caution those that are watching. I'm seeing a lot of these news headlines circulating over the last couple weeks in particular about all these forecasts come out, and these people are forecasting, hey, Vancouver real estate's gonna in a housing recession for the next 3 years, but prices are only gonna drop 2%. It's like, well, how do you come up with that number? And you actually go back and read these other housing forecasts that the same people put out. They're consistently revising the forecast lower and lower and lower. So like none of the previous forecasts have been right, but then it gets spread as if it's like the holy gospel, like, oh my gosh, like this economist said this, so like he has to be right, like here it is. But again, and even those reports, like no mention of what's happening with the central banks or the Fed balance sheet, like no discussion of that. Just talking about housing supply in particular. So which I think, in my opinion, is misguided. Again, maybe different views on the housing market, how they should be analyzed. But hopefully these videos provide some value and maybe a different perspective. Like I said, I don't consider myself the expert or, hey, you should take this as the holy gospel. I just try to provide my own thoughts, opinions, and a lot of it from people that I talk that I would say are much, much smarter than me. I'm fortunate enough to have those conversations with these people and try to provide some of their insights back to you. Other than that, this will be the last video before Christmas, so Merry Christmas. I want to thank you for obviously support throughout much of this year. I hope you have a Merry Christmas, Happy Holidays. Next video will be from Palm Springs, going to visit some family there. And otherwise, see you next week.